Are we in a big, massive bull market, or are we starting a bear market? It's interesting because most investors sit on one of these two extremes, which is kind of odd when everyone's looking at the same market. How could there be such a disparity between views? Well, today I want to take a look at the market really from a factual perspective. I know most people, when it comes to the market, maybe we're trained from following our favorite sports teams, but most people either feel like they're in the bullish camp, like let's go, or they're just in the fear camp that things are going to go wrong and they have that cautious stance. I really want to approach this as someone who's trying to make a factual observation of the market and really decide what steps they should take and what the next steps should be in the market. What does this all mean with how it's acting? So first off, what's causing this massive disparity in view? Well, for those who haven't been watching, basically some of the largest stocks in the world, Nvidia, Apple, Microsoft, especially Nvidia, has been towering higher, just pushing higher and higher, and it's had a massive impact on indexes. I mean, these three companies now have a substantial weight on the Nasdaq 100 and the S&P 500. And for a reason, their combined value is $9 trillion. So if you're really just looking to participate with the stock market as a whole, it's very difficult to argue that the market's anything but a bull market. Take a look at the Nasdaq 100, the QQQ chart. This is clearly in a very nice uptrend. Now, if your task goes beyond just trying to replicate what the Nasdaq 100 is doing, you're trying to actively invest your money, it's a very different story. And this is where the disparity really starts to build from. And we're going to discuss some actionable things we can do to kind of deal with the situation and navigate. So if you're someone who's a little more active, and if you don't happen to be massively positioned in a couple of the main winners that are really powering higher, the question is, what has the rest of the market at large been doing? So the reality is, if you take the same Nasdaq 100 and rather than weigh each stock by its market cap, if you just simply divide those 100 stocks equally to make the index, if you look at the QQQE for equal weight, you'll see this chart hasn't gone anywhere for months. So you have a lot of sideways chop with most stocks not really doing a whole lot to kind of support this bull market. So it's really been a very narrow bull market. Now, it's interesting because the tailwinds behind stocks like Nvidia, I believe, are real tailwinds. So the AI revolution, I think, is real, not of my opinion, not because I think ChatGPT is the most revolutionary thing we've ever done. I'm looking at the amount of capital that's being invested by many companies. If you look at the amount of capital that Tesla's investing, Apple's investing, every major company is investing in this AI infrastructure. No one invests tens of billions of dollars without really have a view of how can we take this investment and turn it to profitability. So just the massive scale of investment, something we really haven't seen, in my opinion, since the internet, means that we are at the cusp of something significant. However, the economy is not hot. We're getting over what's been, very high readings of inflation. To combat that, we've had high interest rates. That impacts most companies. So Nvidia is in a world of its own. They've come out with a breakthrough technology. Everybody's adopting it. They're the clear leader in their space. And they have their fingertips on an incredible opportunity, probably something we haven't seen in a generation. So their stock price has magnified massively. We're up massive just year to date, never mind including last year's gains. And they're able to do that at scale. I mean, this is now a $3 trillion company. Usually the growth that Nvidia is showing happens with mid-cap companies that are 5, 10, 20, $30 billion that can double or triple. So that's very unique. And the interesting part that's causing the disparity is, meanwhile, while Nvidia is putting on this incredible growth and rise in market cap, most companies are struggling from higher interest rates, a consumer that's maybe not falling apart, but that isn't exactly booming. So we have this very large disparity between those who are benefiting and driving this new trend and the rest, which maybe aren't doing terrible, but aren't really excelling either. Now, this is where our indicators are so important, and our mindset and how we go about constructing a portfolio. So in the last video I covered, which you can see the link at the end of this video or below this video, I talk about my five favorite indicators. One of those is my net highs, net lows tool, which I use in every day of my analysis. And a lot of people will now speak to this indicator and what this data shows. It shows how many stocks are making 52-week highs versus 52-week lows. I think people can misinterpret or misapply what this is saying. So, for example, most unhealthy markets will happen when more stocks are making 52-week lows. Some people will argue, what does it matter if those companies are poor companies? I think it matters because they're kind of the sensitive part of the economy. If the sensitive part of the economy is breaking down and there aren't even enough companies that are succeeding to offset those, it means generally there's weakness, and that weakness is expanding. So it's something of concern. You always want to look at kind of the leading indicators, and that's why I would look at those stocks making 52-week lows as the leading indicators to coming weakness. Now, that doesn't mean there can't still be companies or industries that are doing incredible when many companies are suffering, and that is the current situation. If you've been Nvidia, if you're somehow fortunate enough to be fully invested in Nvidia year to date, you are in a different galaxy from what the rest of the market is experiencing. So the way I think the best way to kind of navigate this, if you're an active investor, is rather than kind of think in these black and white terms, I really like to think like Ray Dalio does. For anyone who doesn't know Ray Dalio, one of the most successful investors of all time, he always speaks to expected returns. So what are expected returns? It's you look at what do you think you can make versus what you think the probability is of making it. So for example, if you think you can make a 50% return, but you're only 10% confident that you can do it, you're really not confident. In reality, that 50% return is only worth 5% to you because you have to adjust it down by your confidence. So when I look at these net highs and net lows tools, it doesn't mean that the market has to fall apart. It's showing us the current condition. I really try and avoid the fact that we're looking at the markets going forward and trying to make a prediction. We have to always deal with what we know at the current point in time. So by looking at this indicator, yeah, it means that a lot of stocks are unhealthy. It doesn't mean that the Nasdaq can't kind of frustrate anyone who's bearish and just see it keep climbing higher, but it does show that there are some significant weaknesses. So the way I like to apply this indicator to my actual trading strategy is if I have net lows, I have less confidence in the market as a whole. That means I should have higher cash levels. I should reduce the amount that I'm trading, the speed that I'm trading, the amount of trades that I'm opening up. Because the reality is, for the past couple of months, if you've been forcing trades, if you've been over trading, if you've been trying to buy different stocks to say who else can participate, you're just taking an endless series of losses. Because most stocks have been declining now for several weeks, despite what the Nasdaq's been doing, because it's been the select few, the select great, that have biased everything higher. So by looking at this tool and taking a step back, you can see here at this next chart that in reality, we haven't had healthy markets since about the end of February, beginning of March. That's really where net highs kind of turned over, and then we soon started printing net lows. That means this has been a low probability environment. Slow yourself down, figure out who's winning, focus only on the stocks that are winning, and besides that, slow down your exposure, raise some cash levels. And that's been tremendously helpful because it's one thing to be wrong. You at least, if you're going to be wrong because the market's not conducive, you better be as small as you possibly can be. And if the market becomes healthy, you want to be able to pivot and be as aggressive as you can be. So by looking at the market in these flexible terms, by operating according to your level of confidence, your level of probability that you think that you'll succeed, it allows you to kind of break away from this mindset of, I'm a bull, let's go. And then when markets fall, you're shocked you can't understand what went wrong. Or things are going to get bad, the economy is really going to get worse, and you get stuck in this bearish persona, and then markets go up and you just look at it with frustration and you're just forever waiting for that bear market that never comes. If you can instead think in flexible terms and you can say, look, if we have a series of net highs, and this is my preferred method, people can use whatever tool they want, but if we have a series of net highs, 3, 4, 5 days and things are improving, hey, there's net progress out there. There are a lot of stocks making 52-week highs. Let me see who the market's rewarding. Let me look to increase exposure. If we have more stocks breaking down, there can still be stocks that are winning like we have right now, but let me slow my pace down. Maybe there's some other kind of general malaise that's going on in the economy and that's impacting most stocks, so I better be incredibly selective. I better be very sure that whenever I outlay risk, when I outlay my capital, that I'm going to be rewarded and that I'm aware that things are deteriorating under the surface. By having this flexible mindset, you're never locked into a position. You never get caught offside by a major trend. And the reality of this business is that it's anyone who fights a major trend is the person who has the greatest risk. If you're incredibly bearish at the onset of a big bull market, well, you missed out on incredible opportunity. And if you're in the business, well, you probably aren't going to be employed for very long. And if you're just wide-eyed optimist, just forever bullish as things are deteriorating and these massive bear markets do come around far more often than we realize, financial crisis, COVID, all the other even still substantial corrections in the middle. Well, if you're just overly invested, you can completely blow yourself out, especially if you're on some margin or you're in some highly speculative stock. So you need that balance. You need that perspective. You need a factual way to measure this. And you get to choose how aggressive you want to be in your portfolio. If you're wrong, but you're only 30% invested, you're not going to do too badly. So if you're wrong, but you're 120% invested, you're in trouble. So by using these tools, we can get to a more factual based decision on how we should be positioning in the market rather than our emotions, rather than our opinions, rather than just rooting for a certain camp. So looking at the current environment, what do we do? How do we operate this environment? Well, I've been just directing my capital as much as possible to what's working. And I've always had a bias, unfortunately, recently against large cap stocks. I usually like mid cap, small cap. They usually outperform in good markets. This has been a different cycle. So I've lagged a little bit in that respect. But wherever I've been putting my money, like Celestica, others that are along the theme of AI and this technological infrastructure move, those have been working. And you look to kind of put capital there. And besides that, you stay safe. That can change at any time. There can be a catalyst from the Federal Reserve. We can get better government policy. We can get a new productivity breakthrough on top of AI, which will lead to new winners. The world eventually tends to work in a positive direction. So just because a lot of stocks are not working now, a week from now, the world can be a very different place. If we start to see a lot of stocks start to succeed and make new 52-week highs, it's time to pivot even more capital into those that are working. So right now, my opinion, it's a matter of general caution because despite the market being at all-time highs, most stocks are moving lower and breaking down. And if anything, you want to just work the one trend that's still working, but you probably want to work with a little less exposure because the market at large is weak, and eventually that will likely have an impact. But we want to keep that open mind and pivot with the market. So are we in a massive bull or a massive bear market? This is one of those unique situations where it's a market of stocks rather than a stock market. Every cycle that kind of changes. Sometimes most stocks move together. Other times you have very thin participation. A few stocks move one way and the rest move the other as there's really dramatic flows within certain industry groups and certain themes. So I hope you enjoyed this presentation. I hope you kind of keep an open mind and use a more fact-based approach to deciding where to put your money and how aggressive to be. And you can follow the indicator. There's a link below if you'd like to follow that. There's also a link to my YouTube video from last week where I discuss all of these indicators. You can follow me on Twitter at trader_mcaruso, or you can follow me on our website at carusoinsights.com. Talk to you soon.